So, welcome everyone. Just checking that all the settings are correct and making sure streaming is good. Everything should be good. We are streaming. Let's have a look. No issues there. Should all be good. And you should be able to see my face as well as hear my voice. So, thank you very much for joining me. My name is Adam Harris. I'm a chief market analyst, and I am one of the team of Trade with Precision. I'm speaking to you today from the UK, from near the coast. I'm 10 minutes from the beach in the UK. And this is part of today's webinar is part of the strategy and focus webinar series. Specifically, we're going to be talking about which assets could hit record highs in May. And it is interesting because, of course, there is an old expression which says sell in May and go away. But it turns out that historically that has actually really been a reason to go away, meaning that the markets can often outperform between May and August, for example, which is, for those of you in the southern hemisphere, this might not mean anything, but in the northern hemisphere, everyone's pretty much on holiday, whether it's in the US or Europe or the UK, at some point kind of between May and August. It's just crazy. There's lots of school holidays, and even when one comes back, another one goes away. And so this time of year, especially because it's summer in the northern hemisphere, tends to have a lot of holidays in it. All right. So to give you a moment to digest this risk disclaimer, and while I do that, audio should be good. You should be able to hear me. I'm just checking it's all good. I'll give you some background behind myself. So I am an independent trader. I trade my own capital. I trade for a couple of high net worth clients, and I'm a technical trader predominantly, although I'm very much influenced by Warren Buffett, Peter Lynch, Charlie Munger, Ray Dalio, and a few other fundamental investors. I am a technical trader. So what does that mean? It means that I look to the chart for my technical signals, although my concepts are often quite fundamental. Also, I trade with the trend. This is very much the trade with precision way. It is definitely, for me, the best way to go about engaging in the markets, and which means that we actually choose to just not engage in any markets that have no trend. It's a waste of time and it's a waste of money, and it lowers the probabilities of success. I think that's enough time. What else? What else do you need to know? No, that's it. So I manage my own stocks portfolio. I day trade in the mornings once or twice during the week, and I also swing trade on the daily, which is just a different time frame. That's all. So on the agenda today, we're going to talk about how to use momentum indicators to identify long and short opportunities across different assets, which is quite interesting. We have to be specific about that. Then the next one is whether the S&P 500, gold, or Bitcoin, if any of those have a better chance of rallying throughout May. We're also going to talk about how advanced traders can use the MACD, the RSI, or stochastic oscillator to stay ahead of the competition, which is actually the same thing as the first sentence here, which is how to use momentum indicators to identify long and short opportunities. It's the same thing. MACD, RSI, and stochastic oscillator, or Williams percent R, or CCI, these are all momentum indicators. Then we're going to talk about risk management strategies to limit drawdowns when volatility increases. Cool. So we'll come back to that because the very next thing is to go to live market analysis, and I want to keep this up because I want to come back to this. I want to refer to this. But one of the things I'm going to do here is just quickly kind of show you some of my results so far. So if we just have a look, just here going through for 2024, it's been a particularly good year so far. I think it's 60% up for the year. But the reason I show you that is because November, December were actually quite terrible. So January is misleading. November and December is where the market goes into a bit of a coma. All right, we're in the Christmas season, middle of winter, nothing really happens. And so often what happens is because your stop loss is closer to your entry than your take profit, your stop losses often get triggered first. But your trades that go into profit tend to stay around for longer, which means they end up closing in January. So January is almost the consequence of 3 months of market profits rather than just a single one. But you can kind of see since then it's been 12.2, 5.2, 10.5. I'm in 2.1. I was actually 2.5. I had to trim some losses yesterday, or trim some positions yesterday. And so it's been a relatively positive year so far. And there's a lot of opportunities, considering the fact actually that March and April we had a really big correction in the markets. This is really important that you understand kind of the situation here. So if we go and have a look at the markets here, let's go ahead and have a look at what's going on. The first thing that I want to do is let's assess whether we are in a bull market or a bear market. Let's just establish that. And why is that important? Because if we're in a bull market, we don't really short the market. We don't short the market. If we're in a bull market, we don't short the market. You are a bull in a bull market. You're a buyer in a bull market. You're not a bear in a bull market. The reason is because statistically, that is the fastest way to lose all your money. All right, now let's go and we'll have a look at the S&P 500. So I've just created this list now. It's not my usual one. This is a new list that I've created today. And so what I want to do is I'm going to take you through to the weekly. I'm going to take you through to the weekly chart, and we're going to kind of have a quick look at everything here. So disconnecting this. So how do we know what are the technical indications of a bull market? And there's about 6. I've got about 6 proprietary ones, but we can talk about 2 or 3 which are the most obvious ones. All right, so first of all, we have a series of higher lows and higher highs, which most people don't necessarily appreciate. So this part of the conversation is aimed at people who consider themselves fundamental investors and don't buy into technical analysis, but at the same time are possibly not satisfied with the returns they're getting. So I'm going to try to convert fundamental concepts into technical signals so that you kind of so that you have some frame of reference for what technicals are using. Because believe it or not, and this is something that's very hard for people to potentially accept, fundamental analysis and technical analysis are 2 sides of the same coin. We're looking at a lot of the same information from a different perspective, or at least we're effectively looking at one as a visual representation of the fundamental information. All right, so if you go ahead and I can look at the numbers on a spreadsheet, that would be fundamental information. But if you chart it for me, if you take those numbers, put them into a graph, I'm looking at the technicals. Okay, so that's kind of the basic concept here. So let's we'll take pink because it's nice and obvious. If we have an uptrend, so very important that this is done on the weekly. Okay, this is done on the weekly. Very, very important. It's important because the daily is quite erratic. It can gap up, it can gap down, and it can change trends here and there. It can lose trends very easily. The monthly takes too long. So you have 12 monthly candles in a year. That's your whole year done. But your weekly produces a lot of information, but it gives you a high enough perspective that you can see what's going on, but it's not as erratic as the daily. So this is why we want to do this. I am recording this webinar. I am recording it. It is being recorded. The only question then is I believe that there is often a follow-up and the recording is sent out afterwards. Okay, don't hold me to that, but that is my experience so far. So very important that we look at the weekly, very important that we look at this, and very important that we look at the S&P 500. We want to be looking at the S&P 500. Why? First of all, the US economy is the strongest in the world, like undoubtedly. It has been that way since after World War I, but certainly since World War II. At the end of World War II, the US possessed 95% of the world's wealth. Now, starting in 2005, going up to 2015, China kind of accelerated a lot of growth, but you can't unfortunately, you have to pay the bill sometimes, and China's paying the bill right now. And so China's economy has shrunk to 60% of the US's economy in terms of that. The US is by far the biggest, by far the strongest. Excluding China, the US economy is bigger than the next 8 countries combined. So that's, that's the UK, that's Japan. It's just absolutely gargantuan, and most people don't necessarily appreciate the scale of the US economy. So then when we look at the S&P 500, that is made up of the 500 largest cap companies, obviously on the Standard & Poor's index, and these companies are global. So this is McDonald's, this is Starbucks, Nike, Microsoft. These are companies that are pretty much in every other country in the world. They're global. And it's 500, so it's a very large sample size. So you've got the Dow, which is made up of 30 companies. You've got the NASDAQ, which is made up of 100. And that 100 is taken from the Dow and the S&P. So the S&P includes almost every single major company that we need to analyze. So we get that sample size from across the world, 500 companies. And so it's just a much better sample size than any of the others. And it includes most of them anyway. Now we look at the weekly. Excuse me, I'm going to sneeze. Sorry about that. So, and it includes that. So when we look at the S&P 500, we are looking at the largest economy in the world. We are getting 500 companies. In other words, it's the largest index in the world as well, aside from the Russell 2000. But the Russell 2000 is mini cap, so it's not really the same quality of data. And we get that. And we get a sense of it. So if the S&P 500 is doing well, that should imply that globally the markets are healthy. And while we're on it, while we're on this topic as well, let's very quickly, and this is not on the slide deck today, so I'm giving you this information bonus. It's bonus information. There's a lot of rumors about BRICS, which is, you know, other countries that are potentially wanting to compete with against the US dollar and the dollar index, and the dollar kind of losing value. So a couple of facts here. Every single currency loses value. So the US dollar is losing value in terms of against inflation. The pound is losing value, the New Zealand dollar, the Singapore dollar, everything loses value. There isn't a single currency that isn't losing value at the same rate against inflation. So when we talk about the dollar losing value, that is irrelevant because all the currencies are losing value at approximately the same rate. It's just tied against inflation. If we're talking about the dollar index losing value against all the other currencies, if we go and have a look at it now, we can, but it's in the same place it's been in the 70s and the 80s and the 90s. So actually the dollar index hasn't varied that much. It goes up and down, it's roughly in the same area. So there's no change there as well. So a lot of that stuff is just probably clickbaity stuff. And then finally, if we get to the idea of, countries looking to find an alternative to the dollar index. So here, or at least not to the dollar index, but to the dollar reserve, the US as a currency reserve. Here's the thing. The country that has to be in charge of that effectively is the world's reserve currency, has to be ideally the most stable financially. Ideally, militarily has to be stable as well. So you don't want a country that is ideally, and I, with respect, I understand that the US is going through potential civil war at the moment. So that is obviously a real thing, and the US debt is obviously a real thing. But those are not necessarily as dramatic and unsolvable as everybody makes them out to be. The BRICS are similar to cryptocurrencies in that they might offer an alternative source of revenue, but they will never replace the dollar. And certainly, I don't think within the next 10, 20, 30 years, unless the US loses independence, unless it loses its democracy, unless it is no longer a democracy. If it becomes an autocracy, it's going to go downhill in the same way that every other country that becomes an autocracy goes downhill. So that's unlikely to happen. In other words, the US dollar is likely to be the world's reserve potentially for the next 20, 30 years. In fact, likely for the next 20, 30 years. So I want you guys to just not worry too much about the clickbaity stuff. It's unlikely because whoever takes over that has to take on the world's debt. And there are very few other countries out there that are as strong financially, that are stronger than China, for example, and certainly remember, and it has to be a universal language. So right now, English is the most widely spoken language. All of the trade agreements, all that stuff has to be rewritten. I mean, it's insane. If you've ever witnessed Brexit and what a mess that is, you take that and multiply it by 100 or 1,000 and imagine that's what it's going to be like to switch the global reserve currency. There are no other contenders. So when you hear that stuff, just understand that it's mostly garbage. At this time, if it's going to happen, I'll be the first to tell you this. Right, let's come back to this. So how do we know we're in a bull market? We know we're in a bull market when, first of all, on the weekly, we have a series of high lows and high highs. Means we must have 4 points. We must have a low and a high, and a high low and a high high. We must have broken the previous high. So when we see that in price, we're usually in a bull market. But in addition to that, if you're not satisfied with that as being enough of an indicator, in addition to that, if price, which is the candlestick here, is sitting above the 50-period moving average. So if it's above the red 50 period, because all I have here is a red 50, a blue 20, a black 10. I'm using simple moving averages the same way that any of the old investors would use. If we're sitting above that, we are also in a bull market. Okay, you'll notice here that there's a minor dip. All right, and this is COVID. So this is COVID. Minor correction over here, and then that's pretty much it for now. This here is during an election year, so these aren't necessarily bull markets, but they're also not necessarily bear markets. But when we're sitting below that, we're definitely not in a bull market. When we're above the 50-period moving average and we have high lows, high highs, we are in a bull market. In addition, and this is an extra one if you want, looking at the momentum indicators, if you have the MACD and it is above 0, if you have that, plus price above the 50, plus a high, low, high, high on the weekly, you are in a bull market. There is no point in history where we have ever been in a bull market where those 3 boxes have not been ticked. Okay, so reverse engineer it. If you have those, you have to be in a bull market. You have to be. You can't get into high lows, high highs, and be above the 50 and have the MACD above 0 if the market isn't bullish and strong. So taking that into account, let's see where we are now. So you can see here, we had throughout 2022, we dropped below the 50-period moving average. We dropped below the 50-period moving average over here. And you can see that we went below that 50-period moving average and we produced lower highs and lower lows. And then we got to a very interesting point. Over here, we produced a low and a high, then a bit of a higher low and a higher high. So arguably, at this point here, you could argue that we had gone above the 50-period moving average and we had broken into an uptrend. So you could say legitimately at this point here, which is end of January 2023, we resumed a bull market. In other words, we hit kind of this period here. It's a similar one. Now, one of the other things that happens after that is often price breaks above the 50, it comes back to the 50 and it bounces off the 50. So I'm looking for something similar to happen over there. It doesn't have to, but if it does, that's a good sign. So you can see here, drop just below it, went above it again. So now what I'm looking to see is, do we break above this high? So we've broken above this high, we've produced a high, low, high, high, we've got another higher low. So when we break above this higher high, if we produce another high, we're definitely in a bull market. So we keep going, boom, we've broken through. So for the people who were extra confident and experienced would detect the first kind of bull market signals there. The second one would be here, which means the difference between January 2023 and May this time, a year ago. Okay, the market goes up and then you get a correction here. So now we need to talk about this as well, because when we get moves on the market, when we get a move like this on the daily, and then the daily does this, and then it does this, what's actually happening is the weekly is doing a move like this, and like this, and like this. Or to put it another way, when the weekly is doing its retracements, the daily is going into temporary correction and vice versa. And it's the same with the monthly. So when we have a period like this, where we go in an uptrend all the way up here and a downtrend over here, what's actually happening is the monthly is having a correction and carrying on like that. So we need to understand that there's fractals, there's patterns within patterns. And so when we get to a section like this, if we're having a downtrend over here on the weekly, it tells me that the monthly is doing a retracement. It's a good thing. And also it came right down onto the highs. The behavior of this is incredibly logical and rational and predictable. It's incredible. And if you don't believe me, and this isn't an upsell, we have YouTube videos where we're talking about what we expect the market to do in these areas, where we highlight this area or this area where we expect it to potentially turn around, and it does. And if it doesn't, then it doesn't. But if it produces certain signals in the same way that it has to be bullish if it does certain things, and if it doesn't do those things, it's probably not bullish. So you kind of manage to work out those things. Plus, there's a couple of other things that are pretty cool. Here, if I take this and I draw a trend line, and I'm generally not a big proponent of trend lines, but the whole idea is that if the market is weak, it can't break higher because it's too weak. It can't do that. So if it's stuck below this trend line, but it starts to breach it, which interestingly enough, it breaches here, and then it breaches it again for sure here. So in other words, that's actually another signal that happens. The market starts to breach the trend line. By that time, it's already produced a high, low, higher, high, so it's already an uptrend and another trend up, but it's also breaching the trend line. So there's lots of beautiful ways in which we can get additional, and you can see it starts to go above 0 as well at a certain point. I don't worry too much about the MACD above 0. I see that as an extra bonus, but certainly above the 50-period moving average and price action structures are crucial. The beauty of this, and let me explain this, and this is directly aimed at fundamental analysts who don't buy into technicals, is that the media is always lagging in analysis of the markets. And for the most part, they won't really be confident that the market has turned around until it starts to break to all-time highs. So often there's months-long lag before the media starts to acknowledge reluctantly that we might be in a bull market. They get a lot more, they make a lot more money from doom and gloom than they do from positive news. They really do. Clickbait was to make you anxious, to make you, to kind of trigger a sort of fight or flight thing, and it's very much born to drama, to make people to read it, to follow it, to get people addicted to, oh no, what's going to happen? What's going to happen next? And so their motivation is to do that. And so we have to just be aware of that, which is why I prefer technical analysis, because it gets me a clue. Technical analysis here shows you the orders that are physically going through into the markets. When you get a bullish candle, that's because people were buying. So it doesn't really matter what the news is saying. If the news is heavily bearish, but the market's climbing, the market's bullish. It's just that simple. All right. So what does that mean? So it means that if we go to where we are today, we are very much in a bull market, and we have been in a bull market since last year, a year ago. We've had a beautiful correction. So this is important. We had a really nice correction over here. I love this because the media was talking about how this was the other shoe dropping. They were saying, well, this was the bear market, but actually it's just going to go back into a bear market here. And actually it had already exited the bear market, had it started a bull market, had its very first correction. So when it changes trends from a downtrend into an uptrend, that was just really a pullback. And since then it's kind of been on fire, and we've had another pullback now. So the market currently is trying to continue on upwards, and it's relatively healthy. One of the other things I want you to see here, as I said, there's a lot of proprietary clues, but look how orderly and sane the behavior is. It's like a heartbeat, it's like a rhythm. So when the market is strong and bullish, you get relatively decent sized candles, and there's a rhythm to it. And then when it goes into a bear market, it becomes a lot more erratic. The swings are bigger, the candles get bigger because the liquidity drops. So if you imagine that if there's a lot of people engaging in the markets, a lot of transactions taking place, it becomes like soup. It's very thick with lots of transactions taking place. When people start to exit the market, not all of them, but some of them, it becomes more liquid. There's fewer transactions taking place. There's more gaps between a buyer and a seller because there's not as many buyers and sellers in between them. And so it becomes more liquid, it becomes more watery. And so you get bigger candles, the moves get bigger, the swings get bigger. And so it starts to calm down. So you can look at where we are now, and you can see again the candles have started to calm down in their size. The rhythm is kind of there as well. It's behaving in a more orderly fashion, and it's exited this kind of craziness. And actually, it's worthwhile historically to look at the difference. When you look at this is Biden and Obama. So people forget that Biden was running. He did 8 years as a vice president, and he helped get everyone out of the 2007-2009 global financial crisis. They forget that, like, he did it before. Then you get Trump, and this is Trump. This is effectively Trump. This period here is where you get Donald Trump. It's literally chaos, which makes, and we've never had that happen before. Like, never had so much kind of erratic kind of behavior, big swings, big chaos. Then Biden comes back in, and it calms down again. You have your bear market, but that's fine. You're going to have your bear market. It's unavoidable. Every 5 to 15 years, you're going to have a bear market. And we had it. It's beautiful. So here's why we're in a really good place at the moment. We had a very strong correction through COVID. And it's often the things that throw the markets. Like usually the number one driver of the markets is interest rates. All right. Interest rates impact the bond markets. Most people have a house. So it impacts the bond markets. And also it impacts, whether companies that are borrowing money with low interest rates can afford to do that. So as soon as the interest rates goes up, they usually will start to take profits and extricate their money and settle those types of things. And so money leaves the market, and you have a bear market because of high interest rates, and the higher interest rates tend to trigger that. But my point is this, is that we had a big correction during COVID. The market had a nice big shock. We also had another bear market here. So we've had two really strong corrections. And so the market has had its bear market. It's had its bear markets, so it's in a way it's kind of rejuvenated and it's rested. It's well rested. And in theory, if past this prologue, we should have a relatively good run for the next few years. Obviously, we have a massive election, the most important election in our lifetimes, happening in November. I think it's the 5th, November 5th, maybe the 8th. That's usually the 5th. It was the 8th last year, maybe it's the 5th this year. And it's the most important election in our lifetimes. And so we want to be paying attention to that. And that could change things. We could see if the administration changes, we could see policy changes. But it's not looking likely. It's not looking likely. It looks like the existing administration is going to have a clean sweep and will stay in. So it looks like it's going to be another 8 years, another 4 years, which means another 8 years for Biden, which means he's done. So I don't know if anyone else has ever done a run like that. It's pretty good. Anyway, so here we go. It's looking really nice, and we can see how nice and bullish it is. So let's accept where we are right now. We've got a nice bull market. Everything's looking nice and bullish, which means, as a general rule, ladies and gentlemen, we don't short anything. It's very foolish to short the market, to be contrarian. If you want to be contrarian, you want to be buying when the market's falling. Because statistically, the market historically, especially when you zoom out, that market does nothing but really go up. That's all it does. Historically, the index, which is made up of the best companies in the world, goes up. It spends more time going up than it does going sideways or going down. And so you want to be contrarian when the market, everyone's panicking and screaming. That's when you want to be buying. But to be contrarian and shorting the market is incredibly foolish. Most people lose their shirts doing this because they forget the simple fact that the indexes tend to go up more than anything else. Now, you can potentially short a stock, an individual stock, which is weak, but you don't want to short the index. So you want to be very selective about what it is that you look at. So let's go, I'm going to clean this up. Let's go through this. Let's start having a look at some of the other markets here. So for example, let's go ahead and look at crypto. So let's look at Bitcoin, and let's see what the status is. So first of all, we're on the weekly here. We're above the 50-period moving average. So we're effectively in a bull market. Yes, we are a little bit overextended. So we need to talk about two things here. One is parabolic behavior. So parabolic behavior is when a market, it has an unsustainable trend. So this is very sustainable when we talk about a 45-degree angle. But when the market's going straight up, it's a bubble, right? So that's a bit crazy. And parabolic is when it goes from sustainable to almost straight up, and often there's a crash. Almost always there's a crash. And so you can see when the markets are starting to go parabolic, not crazy parabolic, but steep. It's not terrible. I'm not too concerned about that. Let me show you one that is parabolic, which is interesting to me. So this is the NASDAQ. When we look at it from a monthly perspective, so now we're looking at the monthly here, we have a very, sorry, we'll turn that off. We have a very steady trend line, and then it changes, and that's fine. But look at this one as well. So collectively, it's the angle of it is, it's hot. If it's a temperature, it's running quite hot. And often what happens in those situations, let me do it again. Often what happens in those situations is this is really where it should be. That's kind of your baseline. So if it does come back, it's probably going to come back to that. That's kind of your trajectory, which is healthy. That's your healthy one. And this is kind of when it veers away from it. So I just kind of want to kind of say that at some point in our future, which could be in the next 5 years or the next 2-3 years, there's going to have to be some kind of a thing which slows it down, which brings it back in line with the stock to cool it down. It can't keep going the way that it is. And now we've seen this. So the reason I want to why is that relevant to this? When we look at Bitcoin, we've had that happen multiple times. We've had it happen multiple times, okay? That means that, let's just do it this way. This was the very first Bitcoin bubble. Then we had a little bit of a bubble up there. Then we had a massive bubble here. And we're in another one now. And the reason for this is that Bitcoin and cryptos are largely driven by retail traders and enthusiasm. But the difference is that from about here, we now have institutions getting involved as well. So institutions are starting to sell and include cryptos in their portfolios to clients. So institutional money is what took it from small time to big time prices, and it's retail and institutional, and it's what you might call it kind of a populist. Let's call it a stock. And what it really is it's a tech stock, because it's technical. I mean, it's digital as well, but it's a tech stock. So it's very similar in its behavior to the to tech stocks as well. The other thing you have to understand is that when the market is bullish, people tend to have, or often have, will find more disposable income to put into the markets. So you will find that when the market is really bullish, cryptos will tend to climb as well, because people are willing to put their money into it because the market's bullish. So in other words, there's a sense of optimism which kind of is pervasive throughout the markets, and so people would put money. So there is a correlation between cryptos climbing and tech stocks climbing, for example. It makes sense because investors are looking, they're more bullish, and so they start looking at, they want to be more diverse, and so they start looking at other things, and so cryptos tend to get there. And so the only thing I want to kind of talk about here is really just a sense of, I said to you there were two things we had to talk about. So the one thing was parabolic. The other thing is overextension. So overextension is if you have a moving average running along here, price kind of goes away and it sort of comes back and goes away, comes back, and then it does this. Then obviously in comparison, the distance we are from the moving average is unusual. It's much further away. It's obviously visually further away. And so you can see the difference here. You can see when we've become extreme away from the moving averages. We did it here and we've done it here, where the moving averages, the 10 and 20, give you a really good location of where the actual value should be, the true value. So the true value is that when you're over here, it's overvalued. And if you're below it, like down here, you should be here. It's undervalued. It's a really good indicator of generally speaking, of when it's overvalued. But overall, it doesn't, well, look, we're in a bull market. There is a certain amount of market optimism. The economies are doing well. The FTSE is going to all-time highs, which, by the way, is another sign of how strong the economy is. So it's another sign of how strong that economy is. Let's just go through and get that information. Okay, let's just refresh it. Another sign is if you follow the UK, which I don't expect any of you to, they've been stuck for a very long time. They've been stuck below certain levels. And it's really nice to see it kind of breaking free now. And that's a great sign, because even while the US was going through its massive correction in 2022, this was the US's correction. I mean, this was the UK's correction. So the US was going down like this, the UK did this, which is incredible, because usually when the US catches a cold, we all get sick. And actually the UK managed to recover relatively quickly. So that is a sign of a very healthy, although COVID was massive, the government response was maybe not as quick or as fast, or maybe not as put as much money into it as the US, but the recovery happened as well. And really my point here is that what I'm seeing in the UK and I'm seeing in Europe is that the US volatility is not impacting outside the US as much as it has in the past. And that's more likely to be because the economies are healthy, meaning that what's going on in the US is just impacting the US. It's not really impacting the rest of the world. So the UK and the German, for example, let's have a look at Europe as well. So let's have a look at that. You can see this is just trending really well. And I've been doing this for 15 years. And I have never in the 15 years that I've been trading seen the markets, seen the UK and German markets, for example, EU markets, continue to do their own thing while the US is going through its own turbulent thing. I've never seen that before. And I think that's a temporary thing. In other words, I think that that's right now because the bull market is so strong and healthy that now look, when you have all stocks going up together, you have a bubble. That's what a bubble is, because the market is, everything is just going up by its without any rhyme or reason. Even a poor performing company's stock is going up when it shouldn't be. That's a bubble. When you have all the stocks going down together at the exact same time, that's a market crash, because now it's not logical or reasonable either. So when you have the difference is that when you have in a bull market like we do now, you have some companies going up and some going down and some going sideways. And in other words, they're all doing their own thing. That's actually the sign of an incredibly healthy market, because what's happening now is people are investing in companies for the most part that they think are doing well, and they're not investing in others that they don't think are doing well. So in other words, they're actually independently evaluating the different stocks. So I'm going to come back to this, have a look at this. And we want to talk about momentum indicators, then we cover that, and we'll go through the S&P. And actually, the point is here is we've already actually spoken about the S&P, gold, Bitcoin. We'll get through those as well. This is the same as number one. We'll talk about risk management. Part of the risk management I've spoken about is saying to you, you don't short the indices. And when we're in a bull market, you need to be incredibly sure about which companies you want to short. Honestly, as pessimistic as I am about, say, Donald Trump's company and I am about Tesla, for example, because there are a lot of people that are pessimistic about that, I'm still very cautious to short them, if any. And the reason is because, for example, like Tesla's really overvalued. It's really overvalued, and it should be worth way less than it is, and it isn't, which means that a lot of it is being propped up by retail enthusiasm and like populism, which means I wouldn't short it because it's not a rational behaving stock. And actually the same applies to Donald Trump's one, which should just be worth zero because there's no value in it, and they have 110,000 users. There's nothing. They've got no proprietary software. There's zero value in it. It's purely a brand that's purely populist, which means there's no value in it. And it should be zero. So I don't short those things. I know they should go down, but they're not. They're irrational stocks. That's the way I would put it. They are irrational stocks, and therefore they are unpredictable. And I want to, when you're trading and you're investing, you are looking for things as close to a sure thing as possible. If you want to be Warren Buffett, which I do. So let's go through and have a look at a few of these. So first of all, look at the EU. I want to quickly show you this. Here's another sign we're in an incredibly strong market. I'm going to go through and show you HK. So this is Hong Kong. This one has been actually the weaker performer for a very long time. So for several years now, this has been going down. And if you look at it now, it's starting to turn around. It started to double bottom here. It's got bullish divergence. And we're going to talk about momentum indicators shortly after this. It's starting to crack through the trend line, started to break through it. It's in an uptrend, high lows, high highs. It's above the 50-period moving average on the monthly. Sorry, on the weekly. I beg your pardon, on the weekly. So HK is now going into, it's starting a bull market. China is the same. So China 50, also beautiful. We're going to talk a little bit about this. Also bullish divergence. Also bullish divergence. Also starting to break. Doesn't matter where you put it, you're starting to break through those things. It's beautiful. So it's also starting a bull market. Also done high lows, high highs above the 50-period moving average. So that's looking great. So we're at the beginning, ladies and gentlemen, of potentially a gilded era, a golden age, where for the next 5 to 10 years, especially if America can stabilize, if it can just calm down internally, then I think we've got a golden era of stuff happening. And obviously, the world now realizes Russia's not a threat anymore, but China is potentially a threat. And that's interesting because China are now matching their military budget with the US, which they've never done. Their budget has always been about 20% of the US's. Now they're matching it. So yes, China is a real economic threat, and potentially in 50 years' time will be the new economy. I think that as long as the US can be stable, I think the US is likely to remain a superpower or the major superpower. 20, 30 years, probably for my lifetime. We'll see. But those are the ones to watch. But Russia is a non-event. Okay, so at this time. All right, so we've had a look at that. We've established the markets are looking nice and bullish, which means actually the ones to watch as well are certainly, I would say, the indices. If we go back to the S&P as an example, so where did I do it now? It was up at the top, S&P. I want you to notice this, please. So, and then I'm going to talk about momentum indicators. So we have this beautiful green candle that happens here. Now, often the market will pull back in, produce a green candle and rally. So this was when it was starting a bigger correction. And it's very important, even though there's a green candle there, it's really important the next candle has to break the high. So in other words, you get a pullback, the buyers come back into the bulls return back into it. They attempt to take it higher. This one was a failed attempt. This one did not trigger. It's really important that we take note of this. This next red candle did not break the high. Then we got a third one. Boom, and then it took off. That's fine. Here we got a pullback. We got our green candle near the moving averages. Here we got a pullback and it took off. So this so far is a successful takeoff. And I bring it, if you go back to here, so if we go back to this, I want you to see this happen as well. So you can see pullbacks here to green candles that take off, pullback to green candle here that took off, and then it stumbled at a double top, and then there was another pullback and another green candle. I mean, all of these are really good. There's a pullback and a green candle. There's a pullback and a green candle. There's a pullback and a green candle, but actually these were bullish, so they were also clues. There's a pullback and a green candle, and again, here was a pullback and a green candle that could have potentially been a losing setup, but then here's another pullback, which is a winning setup, and so on, and then you start to top out. So we've just really had a really nice pullback here. We're starting here. So what does it mean? It means that there's a very high probability that we are about to have another leg up. So in other words, we're just starting it. We're probably, whoops, let's just do this one. Means we're probably just about to start another leg up. And the distance of that leg, I would expect to be somewhere similar to this type of a move. Nothing crazy, something like that. So probably, go through till September maybe. September can often be a very bearish month, September, October. So we could have that. It's ahead of the elections. The market, so again, and this is actually with respect to anyone who is potentially a Trump fan, who is pro-Trump. So with respect to that, he has his father had dementia, and he has dementia, and it's become very visible now, so much so that the media is actually starting to talk about it. But it's been diagnosed about 3-4 months ago, and there's a big difference just in the last 6 months. He has what's called aphasia. So if you know anyone who has it, they can't. He says words that sound like other words. So when he wants to say something like I don't know, gold, he might say mold, because or golf, he can't say. His brain just can't quite do it. And so he's actually legitimately has dementia. His dad had it, he's got it. There's no doubt about it now, because you can regularly hear the gas. This is what they call gas. So he can't talk for more than 2 minutes without something not sounding right, and then just and when you listen to him speak, even 8 months ago, it's different. So it's accelerating, and it's accelerating at a really big rate, which means it's part of the reason also he's sleeping during the day during his trials. He's not in good shape. So I think it's going to become undeniable over the next 3 months. There's 6 months to the election, but over the next 3 months, it's going to become undeniable that he is not capable of. He's not capable. He shouldn't. He doesn't have the faculty. And so I think what's going to happen at that point as well is that I think the lead is going to become very clear. The Biden's just going to be a shoo-in, and it's too late now for the Republican Party to replace him as Trump as the nomination. So it's basically what could happen is, if we get to a point before November that it becomes super clear, there's just no way Trump is going to be president. Even if he's voted in, he's just going to be. He's not. His brain is. He's mush at the moment. Then the market might just keep going. So the market might just be like, okay, we know what, with certainty, we know what's going to happen. But there could be a coup. There could be an actual military coup. There could be something crazy. There's some really crazy stuff going on. There's all kinds of things. America is very dramatic, like all of its movies and TV series. But that's one thing. That's just one thing that could kind of happen. I'm just bringing that up. Okay, so the point is, looking really nice and bullish. We've just had a really nice pullback, and so the market is starting to look very good. So the rally is very high probability there. When we look at cryptos, when we go back to Bitcoin, for example, we pull back into the moving averages. So we're back here where there's the potential for it to rally. But I just want to highlight that we have some resistance in this area. And so it will battle a bit there, but it could ultimately continue through that. I think it looks pretty good in almost every other respect. I think it looks really, really good. Bitcoin is looking very good there. If we have a look at, so that was the indices. I think cryptos in general, as long as they're back on the weekly and they're back near the moving averages, then they probably have had enough of a correction and they're likely to go there. So now let's talk about momentum indicators. So there are several momentum indicators. If we go through to these here, we've got oscillators. We have ATR, MACD, momentum, relative strength, stochastic, Williams percent R. We've got, what else we got here? There's usually a couple of different ones here that we can use. Some of these potentially, anything else? Okay, doesn't matter about that for now, but we often have those. And they're very similar. So what I'm going to do here is I'll add in relative strength index, put that under here. And the best way to use them, so the best, again, it's about using tools properly. The best way is actually, funny enough, not using the overbought or oversold approach. That is not as reliable. It has like a 50-50 reliability thing. It's not that reliable. We tend to use divergence and convergence. So what does convergence means? It means that if your indicator is trending higher, producing higher lows and higher highs, as this is, and price is also doing that, so now that your indicator and price are doing the same thing, that means that that trend is healthy, whether it's an uptrend or a downtrend. So here, for example, you can see the trend producing lower highs, lower lows, and you can see the MACD producing lower highs and lower lows. It tells you the trend is established. So that means that's what we call convergence. That means that if I'm looking to buy, I want a healthy uptrend. So what I want is I want my price to be bullish, high lows, high highs, and I want my indicator to be bullish, high lows, high highs. That's a really simple way of looking at it. That means that if I buy on the next pullback, the probabilities that this trend is strong and healthy and will keep going, that's the best possible green light I can get. You can't get a guarantee, but you can get the closest thing to that. And I prefer to use the MACD because the MACD is simpler. It gives very few false signals. When you look at the RSI here, you can see there's a lot of erratic noise in it. And although it is generally giving me the higher lows and higher highs, I find that it's just a little bit too choppy. So I prefer to use the MACD. And so I'm going to use that for this now. I'm just going to use that as an indication. I'm just going to take that out. But we use them both the same way. We basically look at the lows and the highs. So that's convergence. So convergence is when price is going down, the indicator is going down, and you want to sell. So you want basically, before you hit that sell button, you want the highest probability that the trend actually really is bearish and it's likely to keep going for at least the next move. For at least the next move, which means that you should be able to capture some profits and you should be able to get your stop loss to break even. The highest probability that you won't lose money on that trade. Not guaranteed, but very high probability. Then we have divergence. Apologies. Then we have divergence, and divergence is when we have a disagreement between price's trend and the indicator's trend. So that means that if price is going up like this, so price is producing high lows, high highs, and the indicator starts out doing the same, but then it starts to deviate. So now we have divergence. We have a disagreement between it. What does that mean? It means that even if price was nice and healthy here, prices become tired because the trend doesn't always last forever. So prices become very tired. It means that the momentum has now turned bearish. It's very, very important, guys and girls, ladies and gentlemen. It doesn't mean we short the market. It means that we consider not buying anymore. So there's three things you can do. You buy, you sell, you do nothing. When we see divergence, it means probably do nothing. In order to sell, to go short, in this particular example, we would wait for a few more things price has to do. Has to break a previous low. Ideally, it has to come up to a previous high. It has to produce usually bearish signals, and it has to continue down. So usually we would get a change in trend, and then we would short it. And often shorting it when we do is the safest thing. And the reason why we do this, ladies and gentlemen, is because the market can often go into a bit of a consolidation while it's divergent, and then the divergence kind of works its way out, and then the market carries on up, and then we're back in sync again. So in other words, divergence doesn't mean there's a definite change in trend coming. It means there could be a change in trend coming, but it also means the market has to rest. And the market could at that point do one of two things: consolidate or change trend. And if it consolidates, it could change trend as well. So basically, you just don't do anything until you wait to see what it's going to do next. Then you want to wait and see, is it going to consolidate? And if it consolidates, I want to wait until it breaks out to the upside, and then I resume buying. Or if it breaks to the downside, then I can maybe consider selling. And if it changes trend, I can consider selling. But also, and this is the danger, often remember that we end up with just a temporary pullback. In other words, that we just get a weekly retracement. And so the problem is on the daily, we get ready to short it, and all it is a weekly retracement. And this is when we're talking about indices and index. So this is why it's so dangerous to short a healthy stock or to short an index, is because that index could literally just be doing a weekly or monthly correction, and then it goes back up. So in other words, it only goes down for a little bit, and then it changes the trend. And because most people don't know what I've told you today, they get incredibly frustrated. They're absolutely convinced the market is crashing, and then it just resumes its uptrend. And then because they don't understand that, because nobody's told them about the weekly and the monthly, then they start to cry about how the market's being manipulated, when it's not. We're in a bull market. It's going to do that. It is always going to do that. So let's look at NVIDIA, for example. So let's look at NVIDIA. Let's see what it looks like. NVIDIA's weekly has pulled back to the moving averages, produced a bullish inside candle, and is already on its way back up. Is it parabolic? Absolutely. It's very, the angle of it has got steep, but it still has the potential to continue upwards. And look at the MACD. The MACD is producing high lows, high highs. So it's a healthy uptrend. That's a very healthy uptrend. Look at Meta. Wait for it. That doesn't feel right. What's wrong there? There we go. pullback, bullish candle in the moving averages. Looks like it's carrying on up. Also producing high lows, high highs. Also producing high lows, high highs. So it's bullish. It's bullish MACD. It's above zero as well. That's that little bonus thing I told you about. And it's also producing high lows, high highs up here. Let's look at PayPal. So PayPal's been struggling. PayPal has been really struggling. Just see if we can get this. Let's see what's going on. Just see how much data we have. We don't have a lot of history here. We don't have a lot of history here, but we are on the weekly. We are above zero. We've just gone above zero. We do have high lows, high highs. We are battling with a level of resistance here. The reason I'm drawing your attention to it is because I'm following PayPal. PayPal has been underwater for a very long time. It has just got above the 50-period moving average, which means in a way it's lagging. It's a little bit like HK stocks, the HK index, the Hong Kong index. Potentially got some nice room to move. So that could be something with more upside, which isn't as overextended to the upside as some of the other ones we've seen. Let's have a look at Tesla. Okay, so Tesla is arguably on this time frame. If we want to include that as a downtrend, we might have broken through that, but it's still stuck, I think, within the bigger picture downtrend. I still think it's kind of, I don't want to say anything just yet until we break through that. It's below the 50-period moving average. It could possibly be finding some resistance where it is here, potentially. It's a weird behavior. It's very weird behavior. I would have expected it to be able to come up more in line with that. So it could be where it is now. We'll see. So really, what it's doing now is pretty important. If it manages to get back up above the 50 from here, I would say so. But we have the MACD is trending lower, price is trending lower. So we have a bearish MACD, bearish price action. We're below the 50-period moving average, and we're below zero here. So what does that mean to me? It means that currently Tesla is in sell mode. It's in sell mode. And we're on the weekly, which means that in order for us to become bullish on Tesla, we need to see weeks worth of behavior. We need to see a pullback and produce a high low, higher high, or break up above the 50, potentially go bullish, maybe break above that. And so we're looking at 3 months. We need to see what the next 3 months is, the next quarter. So basically for now, I would monitor it, but the only other clue that might mean something is if it breaks above this high, but it would have to break above like a nice bullish candle that closes up here. Not a rejection candle, not something where it closes down like this and it just there's a spike above the level. Have to be a big green candle like this one that closes up here. Then that would indicate, okay, maybe the momentum shifting, maybe. But then you could get a rejection here and carry on down because of this line here. We'll see. But that's the kind of thing that I would be like, okay, let's see what happens next. Then it's not necessarily as weak as it was. But right now, where it is, if it carries on down from here, and also if it does reject where it is here, there's a very high probability that this is its next target. If it does, okay, because the bears, there's a lot of people waiting to short it, a lot of bears, a lot of people, and right now it is in sell mode. So it's not a, so it's interesting because a lot of people are like, oh, this is a good buying opportunity. I'm like, no, this is more a selling climate than a buying climate. You don't buy when things are tanking. You don't, if the Titanic is sinking, you don't buy it as a boat. You don't do that. And you can see the difference between Tesla and all the other ones we had a look at. Okay. And so, yeah, the point is there's a lot of different things that we can do here. So let's have a look. So the indices for the most part are nice and bullish. They've all had a nice weekly pullback. We do want to be aware of September coming. So September, we might still get a correction in the run up to September potentially. We want to be aware of the US elections that are happening. Let's have a look at Disney. Disney is also very nice. So Disney has also, ladies and gentlemen, just managed to turn around. So look here, look at how the lower lows started to diverge. We started to get higher lows with the MACD. So the MACD starts going bullish. Price does that. Now price has done a higher low, higher high. So there's your low, there's your high, there's your higher low. You broke through that. You're also above the 50-period moving average. Technically, it came back and tested the 50-period. It's also come back here and tested that. Beautiful. So let's talk very quickly about risk management. So there's a difference between whether you're a trader or an investor. If you're an investor, I think you also need to decide, okay, if it goes below the 50, I sell my shares. Now, you have two approaches. You buy and hold forever, but then you really want stuff that stays above its 50 more often than nothing, than anything else. So like an example of that would be Microsoft, or Microsoft. Let's go with that. Microsoft is generally an outstanding performer historically. Very, very good. It's very calm and rhythmical. It's beautiful. That's one example. Then you're safe. You're going to get your money. Okay, so you need to ask yourself, why am I picking something? Am I picking the stock because I know someone who works there, because I like the sound of it, because I use the products, because it's popular, because all my mates are doing it? When I look at it like this, what does its heartbeat look like? What does its structure look like? If it has a historical, think about it like this. If it has a habit of being successful, then it's a good investment. If it literally habitually makes money, it's a no-brainer. But sometimes people like to pick stocks that have been tanking for several years because they think that somehow that is a winner. A winning stock, is something that has a track record of winning, not a track record of losing. That's a loser. So you want a track record of winning in with global markets. So we have a bull market now, and the only stock that's tanking is Tesla. And if you bought at any time in the last 4 years, you'd be underwater now, statistically speaking. So that isn't, by any definition, a winning investment. So that's investing. As a trader, it's different. As a trader, ladies and gentlemen, you're not an investor. You're looking to capture just a short-term move. You're looking for just that move, just that move, just that move. So people look here, they get in here, their stop loss is there, and that's their profits, and they get out. They trail their stop and they're out. So traders are doing shorter term in and out on a much more frequent basis, and obviously will have more losses and more wins because they're just engaging in the market more often, but often also make more money, especially when the market's trending. So stock traders have historically made a ton of money. Stock trading is, in a way, if you're in a bull market, is almost a no-brainer compared to trading currencies or trading commodities, because the best stocks will only go up. So you just create a watch list of 20 of the best performing stocks, and every time they pull back to the moving averages, entry and stop loss, and you just go and you target 3 to 1, or you do a trading stop loss. It's like, it's easy money in comparison to the other stuff. So just something to keep in mind. Risk management, and that's what it is. And so a lot of people, I've had people put their pensions, there's people who are Tesla investors who are living out of their Tesla because they put all their savings into it, and their wife divorced them because they think their husband's a lunatic, and then they don't have a house anymore. Like, that's the status of that's insane. So when we're trading, as a trader, you would be not putting 10% of your budget into this. You'd be putting 1 or 2 or 3% max into each trade that you take across 10 or more stocks. As an investor, I have 59 constituents, 59 different stocks, including a couple of ETFs in my portfolio. But I mean, I can afford that. Meaning that each one is, I started at $500 on Apple and $500 on Tesla, for example, whatever, $500 on IBM, and so you just build it up over time. And the only reason to go all in on one is if you're Warren Buffett and you really understand the fundamentals. But the fundamentals are key. It has to have a moat. There's like 7 criteria that it has to have. Good management. So the management has to be stable. They can't be erratic. They can't be emotional. So already that excludes, and they have to have a moat, something that gives them an edge over all their competitors. And Tesla doesn't have any of that. They've given away their supercharging network, their battery stuff. They're now using third parties for their batteries, for solar power battery storage. They're doing all kinds of crazy stuff, solar power stuff as well. They're buying their solar power panels for their gigafactories from other parties, from other suppliers. They're not even using their own. So there's a whole lot of different stuff going on. They don't have that, and there's instability in management. It's crazy. So I'm just using that as an example of something that people think is a really good thing. That's just there's just red flags everywhere. So but yeah, so there's a lot of opportunities, ladies and gentlemen. The weekly is a great way to do it because the weekly will give you a smoothed out version. It gives you enough time. You hold positions for 5-6 weeks. If you're an investor, you can do both. So as an investor, you can get a buying opportunity here. Even as traders are getting on the shorter term move, you can be getting in on the longer term move. But the timing of today's webinar is fortuitous because we've just had a really nice correction, and it looks like we're now at the beginning of the next leg up to the upside. So there we go. Ladies and gentlemen, I want to say thank you very much for your time today. If you have any questions to do with your account or to do with the platform, please do not hesitate to get in touch with the lovely folks at Vantage Markets. You have all of the contact details over here. Please don't just choose, whichever one you prefer to get in touch with them. And I want to say thank you very much for giving me your time. I'm going to stop the streaming and I'm going to end the webinar. And I want to say thank you very much for your time. I really appreciate it. And I wish you a great week. And again, sensible trading, sensible risk management, guys. There are lots, guys and girls, there are a lot of opportunities out there. So thank you very much.